Good afternoon, good morning, depending on where you're listening to us from today. Welcome to another great educational webinar here at Advanta IRA, where we're going to talk today about the precious metals market and really looking at some current data. Since the last time we had our guest speaker on, some things have changed in the markets, things have changed data-wise as well, and want to make sure that we cover those and get you some up-to-date information with our guest speaker. So anyone who is listening to today's presentation live, you can use the question box on your screen to type any questions that you have either for myself or for our guest presenter regarding the topics that we are covering today. So make sure you get those on the in the question box, and we'll try to do our best to answer what we can during the webinar. If you have any questions after the webinar, or if you're listening to this recording, you can reach out to me. My name is Scott Maurer. I'll be the host of your webinar today here at Advanta IRA. My contact information is here on this slide. I'm sure our guest host will share his contact information as well if you have questions on the precious metals market and what's involved potentially in making gold or silver part of your investment portfolio with your retirement account. So again, my name is Scott Maurer. I'll be your host for today. I'm the Vice President of Sales here at Advanta IRA. I've been with the firm for a number of years, well-versed in a lot of the things self-directed, whether it's precious metals, real estate, private placements, a lot of different types of assets that you can invest in with your IRA account. I'm happy to answer those questions, or even if you just have a question on RMDs, required minimum distributions or contribution limits, we're always willing to get those answered for you and help you get those things that you need cleared on your retirement portfolio. Just a quick disclaimer, Advanta IRA, when we do webinars, we do our educational events. Advanta itself does not provide investment advice. We do not endorse any particular products or any investment providers, including those people who you might hear on our webinars as well. We present the information for educational purposes, and all parties are encouraged to consult with your attorneys, accountants, other advisors before entering into any type of investment. If you are looking for some more guidance on the tax or legal or investment side, we can certainly refer you or give you the names of other companies or other individuals who might be able to provide those legal or tax advice and due diligence maybe as well for investments, since we are again unable to do that at Advanta IRA. A little bit of background on our company for anyone who is new to our company and new to self-direction. Advanta IRA has been around for almost 20 years. Only thing we do at Advanta is the administration of self-directed IRAs, basically taking your IRA account, using the funds within that account to invest in alternative assets against things like real estate, precious metals, private lending, private startup companies, things of that nature. The common thread that all of those different investments have is that you can't typically hold those assets on a more conventional platform, like with a Schwab or a Fidelity or someone like that. So what our firm specializes in doing is holding those assets, and then we don't sell any investments. It's simply providing the custodial work to hold these assets within your account. We have over $3 billion in assets under management, and we have we set ourselves apart with our concierge level personal service, where every new account, every client gets assigned to a specific account manager so that you have one point of contact for anything you need regarding your account, whether you're making an investment, maintaining the assets within the account. We really pride ourselves on our customer service and also on our educational offerings, basically bringing information to you on a weekly basis. We do 1 or 2 webinars a week. We do we are very active in our networking events and in our local communities. And we have a great video library. So the webinar you're listening to today, if you're listening live, it is being recorded. So if you'd like to go back and listen to parts of the presentation again, you can go back and get the recording. Anyone who's listening, obviously, to the recording, you're getting that now. But the good thing to know is all the webinars that we do, we record them and we place them on our YouTube page. So if you miss an event, or if you wanted to go back and check something out again, or maybe just to get some more information, head to our website, click on our YouTube link, go right to our video library to access. Again, a lot of great information, a lot of great guest speakers we've had on quite a number of different topics. But we're talking today again about precious metals in an IRA, and really going to be looking at the current state of the market, analyzing the current data that is out there with our guest presenter. But just a couple of notes about precious metals in your IRA to make sure that people understand what you're permitted to do or not permitted to do with these types of assets in the account. it is important that you make sure that when you're buying gold, silver, platinum, or palladium, that they meet the IRS defined fineness requirements. So you can't just pick out any old coin. The coin has to be typically 99.5% pure gold, pure silver, etc., to be allowed as a investment inside of your IRA account. The IRS does prohibit you from holding any type of collectible item, which would include the rare coins, the unique coins, things of that nature, or metals that are not meeting that fineness requirement. An important thing to note is just because a coin was minted by a government doesn't mean it's qualified for an IRA. So you're going to want to work with a dealer or someone who knows what types of metals that they're selling and that they're qualified within an IRA account. One thing I'll talk about briefly here as well is that when individuals buy metals inside of your IRA account, it's important that you're going to have those metals stored at a third-party depository institution. Advanta IRA is not equipped to store gold bars or gold or silver coins, and the IRS rules do not allow you as the IRA owner to have physical possession of the precious metals owned inside your IRA account. So it is important that when you work with companies like the Delaware Depository or IDS or one of the other dealers or one of the other depositories out there that will actually hold the metals inside your IRA. There was a court case a few years ago where individuals had been trying to get around that requirement that a third party hold the metals, and individuals were setting up LLCs for their IRA accounts where the IRA owner is the manager of the LLC, was physically holding the metals. So they were buying the metals not directly in the name of the IRA, but by using a single member LLC to try to get around the requirement that the metals be stored at a third party. That was the case of McNulty v. Commissioner, where the ruling was indeed that the IRA owner was violating that requirement, even using a single member LLC. So be careful if you see people out there selling that you need to invest through an LLC and you can store the metals. Again, based on that court case, that is not permitted. Just the other key thing to note, we like to note, we work with a number of gold dealers. The people we're having on today are great, give great information, and that's why we're having them on today. But again, it's up to the gold dealers, the silver dealers who you're working with to determine which products and help you determine which products are investment grade, the fineness requirements, and also do your due diligence to be satisfied with what you are paying. When you are buying and selling metals, you'll have different dealers with different spreads. That's the amount of money, that's basically their commissions, their what they get paid for the transaction. So shop around a little bit. Do get a couple different quotes, see what different people are offering when you're buying those metals, because again, that is not something that Advanta IRA does. We simply process the investment as you tell us to do so. So again, most of them, in general, the metals that are allowed: gold, silver, platinum, and palladium. They come in different sizes, 1 ounce, half ounce, etc. Certain coins, a lot of them minted by the U.S. Treasury, but there are also some permitted that are minted in other countries like Australia, Canada, and Great Britain. In addition to buying coins, you may also buy certain bars or rounds that meet the acceptable fineness requirements. So a couple things, again, I mentioned already, rare and collectible coins are not permitted, as well as dory bars, which is really, I think, kind of like an unrefined gold or silver that does not meet the fineness requirements. So when you work with Advanta IRA and you want to buy precious metals, you could choose from a number of different depository institutions. So we have a list of, I think, 7 or 8 different ones that you can choose from, or you can work with the dealer you're purchasing from, and if they have a depository that they prefer, and connect with them there. So a little bit on the precious metals purchase process. It's not overly difficult or complicated. It's a matter of establishing your IRA account, transferring cash into your Advanta IRA, and then directing us which dealer you wish to purchase from. And our job will be to work with that dealer to make sure that the invoice, you're selecting how many different coins, how many different bars that you want to purchase, what the price will be for each of those items, and you're going to approve that invoice for us, and then ultimately we send the money to make the purchase, and the gold dealer ships your metals then to the depository institution that you have selected. So it's a fairly straightforward process. It does happen usually pretty quickly, as your dealer is going to want to lock in certain prices. But again, if you have questions on the precious metals purchase process through an IRA account, you're certainly more than welcome to reach out to me. I'll put my information up again here at the end of the presentation. But I wanted to bring on our guest speaker today, Greg Allen. He founded Allenhouse Metals back in 2017. They offer the purchase, sale, and storage solutions for different types of precious metals. We've had Greg on a few different times to talk with us and talk with you, our listeners, a lot about the markets. Really not, he's not trying to sell the metals himself, although they do provide that service. Really provides you with the information you need when you're analyzing when's a good time to buy, when is a good time to sell within the precious metals market. So I'm going to bring Greg on, allow him to share his slides. And again, if you have questions for either Greg or myself as we go through the presentation, type those into the question box. But this time I'll turn the presentation over to Greg. How you doing today?
Good, thanks, Scott, and thanks again for having us on. We really, we enjoy these sessions that we get to have and educate people. And I just want to reiterate for everyone that's on here, we're going to go over some technical data today, some dot plots, some charts. No question is a stupid question. So if you have any questions at all about process or charts or trends or anything like that, don't hesitate to ask, and we'll get to them all. Just moving forward here, just a bit about us and our core values. I think one thing everyone can agree on is there isn't a one-size-fits-all approach to any type of investing, whether that be metals, stocks. When you're looking at your portfolio, we really want to make sure that we understand your objectives, right? Our end goal here is to help you create a portfolio that's tailor-made to fit your needs. So, whether your goals are capital appreciation, preserving purchasing power, our job here is really to educate you so you can make decisions and help navigate your financial future. Now, just off the top, Dillon Gage. We are a registered dealer with Dillon Gage. They've been in business since 1976. They are the authorized purchaser for the United States Mint, the Canadian Mint, as well as most other government mints around the world. Okay, they don't deal at a retail level. They're only dealing institutionally. But they have a hand in about $1.5 billion worth of gold and silver every single month. They're located in Dallas, Texas. And as well, they own IDS Texas. So I know Scott had mentioned, you have 7 or 8 options when it comes to depositories. We work with them all. Our choice, however, over the others personally, is to deal with IDS Texas specifically. IDS, like I was saying, it's a wholly owned subsidiary of Dillon Gage. And they're actually, IDS Texas is in the same building as the warehouse from which we ship all of our metal, the same distribution facility. They hold all of the top certifications. So they're COMEX approved, they're ICE approved. They hold a certification from the London Bullion Market Association, which is about the best certification in metals, LBMA. Additionally, for Advanta clients, and I know we talked about this at our last webinar, you are able to attend the facility for an audit. So I know one thing Scott was mentioning is, according to the IRS, you cannot take possession of the metals at which you hold in the IRA. However, should you want to go see your metals, as long as you give us 10 days to 2 weeks as a heads up, we can set up what's called an audit. So we can actually go into the vault at IDS in Texas or Delaware, whichever location you're at, and you can audit and you can hold your metal in hand. We've done it for Advanta clients and other clients alike, and it's a really cool experience to get to see everything in person, that's for sure. So moving forward here, I mean, one thing when we look at metals, a lot of people look at precious metals as a safe haven, right? They typically soar in value during times of uncertainty, geopolitical tensions, and when paper markets plunge. But the one thing you'll see today is studies over long periods of time, 50-year studies, have showed that precious metals consistently outperform equities and real estate. And additionally, not only can you look at them as a safe haven, but really I think they should be looked at as something that can be a consistent performer in your portfolio. So when we look at, precious metals, one thing that, gives us that safe haven is they're guaranteed to hold intrinsic value. Okay. They rise over time with the cost of living, which high inflationary times, right? And all this means is, let's say, 100 years ago, you were to buy a house, and a house at that time, for argument's sake, let's say it would cost $3,500. Well, if you bought $3,500 worth of gold instead of buying that house 100 years ago, and 100 years later today, let's say that same house went from $3,500 to $500,000. The gold that you bought that was $3,500 would rise with the cost of living over time, and it would buy you that same house. It's a value store, right? So when you're looking at precious metals, you're looking at something that will rise with the cost of inflation over time and hold value, right? Now, the most important thing, and I'll reiterate this as we go through, is the dollar. When we're looking at precious metals, the most important thing to look at, you have factors like supply and demand, yes. You have other factors like geopolitical tensions, but the most important factor that's going to affect the price of gold and silver is the dollar. Now, when people are looking to make a purchase of precious metals, a question that I get a lot is, should I buy an ETF or should I buy the physical metal? And one thing that I find, a lot of people have a question of, or what used to prevent people from buying physical metal was liquidity. And so we take that completely out of the question. Anything that you buy from us, we buy it right back. I don't want you to think that you're going to have to go shopping it around and selling it somewhere else. You're 100% liquid at all times. Additionally, the other reason why I see a lot of people leaving ETFs and buying physical now is because of the change in prospectus in metal ETFs like GLD or SLV. There's others as well. But over the last few years, they've changed their prospectus. They no longer back those funds with physical purchases of metal. So because they don't back the funds with physical purchases of metal, what stands to rest is that those funds go up and down with the volume of buying and selling into the fund. And not just that, on page 7, they also change the prospectus so they can liquidate those funds at any time without investor consent and give you liquidation value. So if you were ever looking in between ETFs or physical, it couldn't be a better case right now to buy physical as opposed to the ETF. Additionally, and this is the last thing I'll say on ETFs, not only do they not back them with physical anymore, a report came out in January of this year that shows over the last 3 years, roughly 70% of the physical metal that was stored in these funds has been sold off. The reason being is if the funds no longer have to back themselves with physical metal, they don't have to worry about carrying a bigger balance sheet, paying for the storage, holding this metal. So they're liquidating and they're getting rid of it. And so it's a lot less secure than it used to be. Now, what I want to draw our attention to here is this dot plot. So this dot plot actually came out, our last webinar about metals was March 20th from 12 to 1. This came out an hour after our last webinar from the Fed, okay? And it's unchanged from the dot plot that the Fed released in the previous December, okay? What the dot plot shows, if you look in this first column here, this shows the projections of the 19 Federal Open Market Committee officials for interest rates for 2024. Then they have 2025 and then 2026. When looking at this, what we'll see is both in December and in March, they forecasted 3 interest rate cuts, a total of 75 basis points or 0.75%, depending on how you look at it. Which would bring interest rates down from 5.25 to 5.5%, where they are today, to 4.5 to 4.75%. Furthermore, at the March meeting, as well as the December meeting previously, the governors agreed that they would bring rates down in the range of 3.5 to 3.75% in 2025. Now, the clear thing I want to point out about this is at the beginning of the year, we had major banks calling for 125 basis points in cuts, or 1.25%. That is absolutely not going to happen, okay? The reason major banks were calling for this was not only for solvency in their own case. As we know, last year, we had more bank failures than we did in 2008 when we look at it in a dollars and cents perspective. But additionally, they're looking at it in terms of paper markets. Now, what I want to draw everybody's attention to here is the updated dot plot. This dot plot was released, I believe, June 12th this month, and it is the first time the Fed has updated their dot plot since last September. Now, what's changed in the dot plot here is we're now more in line with what Jerome Powell had said in the fall and again in the winter, is the Fed is looking at keeping rates higher for longer, okay? The main reason for this, and you'll see this on the following slides, is the Fed is going to remain data dependent, and they do not want to cut rates too early until they're convinced that they have gotten inflation to their target of 2% or as close to that target as possible. So if we look at this updated dot plot here, if you can see my mouse on the left-hand side in 2024, in March, where they were previously calling for 3 cuts totaling 75 basis points, they're now forecasting 1 to 2 cuts total on the year, which would be between 25 basis points and 50 basis points, meaning they're forecasting for the rates this year to stay elevated above 4.75%. They're forecasting these rates will settle between 4.75 to 5 or 5 to 5.25% on the year. Furthermore, if we look at the last dot plot, I'll just go up to show where you see them almost unanimously agreeing that rates should be below 4% by 25. We're now seeing the complete opposite, and they're seeing rates remaining above 4%, around that 4% target through 2025. A big reason for this is the Fed believes that inflation is not transitory like they originally were stating a few years back. They believe higher inflation could be here to stay throughout the decade. Part of that is because Powell has cited himself that the Biden administration spending has been completely out of hand, to a degree where $7.6 trillion of government debt is coming due this year before the election, and government debt purchases, or rather US debt purchases, are at an all-time low with developments of organizations like BRICS, and because of the fact that nations are accepting other currencies than US dollars for oil now. So moving along, what this puts us at, our current interest rates are at 5.25 to 5.5%. We're looking at 1 to 2 cuts on the year. So this puts us, if they make 2, at 4.75 to 5%. If they make 1, it puts us at 5 to 5.25%. Now, before I move on, I want to let everyone here know there's a tool, and I think everyone here should use it. It's available to the public. It's called the CME Fed Watch tool. If you Google it, it'll come right up. It is the most important tool you could use when tracking the Fed. What it does is it'll show you every single Fed meeting for the year, past, present, and future, and it'll show you the percentage chance of rate changes, whether that be up or down, based on votes from decision makers and leading economists. If we look at it now, the CME FedWatch tool is currently projecting that these rate cuts will come in the wheelhouse of September to November, whether it's in September, October, November, whether it's one of those, two of those, all of the above. This is a really important tool, and we use it because these interest rates have a massive effect on the dollar. And you'll remember, I said the dollar is the most important thing that we're going to look at when it comes to gold and silver prices. So it's important to consider this forward guidance when we're looking at making gold and silver purchases, because it tells us a lot about where the market's going to go. So moving forward here, I wanted to show everyone here what could cause the Fed to hold off on the rate cuts and in fact make less rate cuts than they had previously stated on the year. What we have in front of us is the CPI, or rather Consumer Price Index chart. It's dating back to 2004. And this is data that gets released monthly. Now, this data that we see in front of us, the CPI is the most indicative of how inflation affects people like you and I, meaning it includes things like your groceries, your gasoline that you fill up at the pump. Other tools don't necessarily include that. If we look at this on the far right, we're down right now well above 3%, but in the mid threes, okay? While that's a long way down, it's 1/3 of where inflation was just 2 years ago at 9.1%. We're still well above the 2% target of the Fed. And in fact, right now, the CPI inflation data is the highest it's been since 2011. And this is one of the key factors that would go into the Fed delaying these cuts. Remember, the Fed has said they're going to be data dependent, right? So this is some of the data that they're looking at when they're making their decisions. One thing that the Fed is concerned about is if they cut rates too early, it could lead to a stagflation crisis like we saw in the 70s. And for reference, last time we saw that stagflation crisis in the 70s, we ultimately saw interest rates by 1980 raised well into the double digits, as I'm sure most people on here will remember. But additionally, in that stagflation crisis, we saw gold actually move from $35 in 1971 up to almost $900 by the end of that decade. So moving forward, what we have here on the next slide is the PCE index. This stands for personal consumption expenditures, okay? This is the tool that the Federal Open Markets Committee uses to evaluate inflation. This is their baseline for inflation. Now, this doesn't really show core inflation as it affects you and I, because it does not include food or energy, right? Like gasoline, oil, these types of things. But the reason is clear as day in why you'll see the Fed delaying these cuts when you look at this chart. If you look at Q4 here, they had PCE down to 0% in month 10 here. You'll see in October, and month 11 in November, and down to just 0.1% in December. When we look at Q1, first quarter of this year, the PCE rate is higher in Q1 than it was in Q4. And so this is what's led to a lot of concern from Fed officials, and the reason for a lot of the delay. One thing I also want to note here is, while the Fed is delaying these cuts, the European Central Bank, the Bank of Canada, and the Bank of Switzerland have all cut rates. And this is something that's unprecedented. These are our central banks that typically wait for the Fed. When I say typically, the European Central Bank has never cut rates before the Federal Open Market Committee has cut rates. And so the major reason for this in other countries is their central banks have realized they cannot hold on any longer. For instance, in Canada, business failures are up over 87% on the year. And the reason I mention this, when we look at our own economic data here in the US, a lot of it would be referred to what's called Goldilocks reports or Goldilocks data. It doesn't actually show how dire the situation is. For instance, on the year, we have lost 1 million full-time jobs thus far. And I reference full-time jobs because these are considered to be good paying jobs, right? Meanwhile, the job reports show that we've increased job numbers on the year. A lot of that is because part-time jobs have soared through the roof, while full-time jobs, we've lost 1 million of them. But the report doesn't come right out and say this. Another thing to note is the S&P has reported 275 business bankruptcies in Q1 this year. The reason that's so significant is for all of 2023, bankruptcies were higher than they'd been in a long time for businesses. There was 277 for the entire year in 2023. So we almost eclipsed the entire year of 2023 in business bankruptcies in Q1 this year. So moving forward, we've been talking about how important the dollar is. I want to show everyone here how the dollar is affected by forward guidance, how it's affected by interest rates, okay? When we look at the dollar, what you're going to notice is it's traded over the last 20 years from strong support at 72 on the index to strong resistance at 104 on the index. And this typically fluctuates as policymakers move rates from 0 to 2.5%, because the range in the last 3 cycles has been between 0 and 2.5%. Now, this time we saw the Fed move because of inflation soaring. The Fed move rates above 5%, right? And so I point this out because you'll see the dollar peaked here in 2022 at 115 on the index. And why is that? Well, simply put, you'll notice as you follow along the chart, if we follow after 2020 here, this is after the pandemic's declared, we had unprecedented money printing, okay? And during this money printing cycle, we see the dollar diluted all the way down to 82 on the index. It did not reach 79, it bottomed out at 82. Now, all of a sudden, in that time as well, we see gold and silver. Gold goes from 1,200 to 1,900. Silver goes from $11.82 in March of 2020 up to 30 briefly. Now, in the meantime, when we start seeing inflation pick up and the Fed realizes that inflation is no longer transitory, we saw over 10 consecutive interest rate hikes, right? So again, instead of raising to 2.5%, they rose to 5.25 to 5.5%. And this is where we see this the dollar absolutely take off and hit 115. Well, now, since then, we've seen the dollar fall off over 10%. We're now seeing the dollar trading in the mid 105s, okay? Now, the significant thing about this is we have not had an interest rate cut yet. However, leading economists are forecasting that as we begin to see these cuts, we should also see the dollar fall from this mark of 105 on the index back to 89 and potentially to 72 over the next 18 months to 2 years based on these interest rate cuts. Now, that for silver, for gold, very significant, right? Gold and silver share an inverse relationship with the dollar, okay? And all that means is as the value of the dollar goes down, gold and silver go up. As the value of the dollar goes up, gold and silver goes down. So really simply put, if you think that the dollar will lose value, gold and silver are a good bet because they're going to go up. Now, moving on, I just want to cite some data that we put forward and that we projected in our March 20th webinar. If we look at this, we were highlighting in March 20th projections made by Gregory Shearer, who is the head of base and precious metal strategy at JP Morgan Chase. He was forecasting that gold would average $2,175 on the year and hit a new record high of $2,300. At the time of our webinar on March 20th, the price of gold was $2,158.29. Okay. Now you'll see as I have it out on the slide, as of closing yesterday, we were sitting at $2,331.80. And since then, we've actually reached a new high, a new all-time high of almost $2,450. Now, the thing I want to highlight here is we've not only blown past through these projections, but in gold, we've now established a firm level of support above $2,300, which was where JP Morgan at the time was projecting gold to go. And we've seen this happen in the matter of 3 months. Now, moving on, what are the updated projections? Well, with the new data that we're seeing, Citigroup, UBS, TD Securities, and Bank of America have all updated their gold projections within the last 35 days, okay? Gold so far on the year is up 13%. UBS is projecting that we'll see $2,600 gold within the year. Seeing $2,600 gold within the year would put us up well over 20% on the year. Now, another thing to note, and Salita Marcelli has come out, she's the Chief Investment Officer of the Americas for UBS. UBS is recommending that everyone buy gold. If you're going to buy it anywhere in the $2,300 range that you can, because they predict that once we start seeing this next move forward, we're not going to have the opportunity to buy at $2,300 again. Doubling down on this, Max Layton, who's the head of Citigroup's commodity research, is projecting $3,000 gold prices by Q1, Q2 of 2025. He's citing, and as we're talking about, remember, the rates and the dollar, lowering rates into the end of the year, early next year, is certainly going to be the backbone of the next move higher in gold. Now, lastly, and this is a relatively new projection, I'm talking about within the last week, Michael Widmer, the head of commodities research at Bank of America, has come out and he's also agreed with Citigroup. He believes gold will hit $3,000 in 2025. And he believes a lot of this is due to ongoing central bank purchases. The big thing is central banks are now backing themselves with gold as opposed to US dollars and US treasuries. And as of right now, central bank purchases of gold make up between 20 and 25% of gold purchases globally, of all gold. Now, of that, the largest central bank purchaser of gold at the moment is China. Now, just to back up what we're seeing in these projections, I wanted to go over this chart here with everyone. Now, what you're going to see in here, obviously, we see massive buy zone around 2150. And if you can get it at 2150, that would be incredible. As Salita was saying on the past slide, $2,300 or close to it is really a fantastic place to buy. But if we're looking at this, since we've broken through $2,300, we have not looked back. On this chart specifically, and you'll see in this right corner, the consolidation after 2454, this is forming what's called a pennant pattern. Okay, and so in a pennant pattern, you'll see we hit a new high, around 2450. And after hitting that new high, we've consolidated in the $2,300 range. What forms a pennant pattern, and it draws like a triangle, like a pennant right here, is the consolidation cycle will get tighter and tighter and tighter until it explodes up into another large rally. So think of it this way. It's like a spring or a coil. As you depress that spring or that coil, it gains momentum. So as those highs and lows get tighter and tighter, it gains momentum until when it's at its tightest point and you release, it explodes upwards. Same thing as a spring or coil, and that's the same thing that this chart shows. And just to reference, you know, how we see that happening in the future with this chart, if we track back to the beginning of the year through March, you'll see the pennant pattern formed. We reach a new high of 2152 in gold here. We consolidate, it gets tighter, 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 and then we shoot up to over $2,400. The exact same thing is happening right here, right now. Moving on here, what about silver? The one thing I want to mention, right, is silver and gold trade in tandem. Okay, silver doesn't do anything just because it's silver. It follows gold. Gold's typically the first mover, then silver follows. But if we look at the silver projections that were made in the last webinar on March 20th, we were citing Gregory Shearer was projecting an average of $30 per ounce in silver through Q4. And one thing that we were citing is the gold to silver ratio suggested there could be more upside to this than what was being predicted. Now, I will explain this in a later slide, but I just want to explain what that is for anyone who's wondering. The gold to silver ratio is a value tool used in precious metals. It tells us how many ounces of silver we can buy for every ounce of gold. Okay, now if the wider this ratio gets, the more undervalued silver is. The tighter the ratio gets, the more undervalued gold is. Okay, now the primary reason that Gregory Shearer was giving these projections was due to the US dollar falling in value with interest rates declining and falling yields due to the rate cuts. We've seen silver in the meantime, it was at $24 and change, $24.78 at the last webinar. It reached a new high of $32.10 and has since consolidated to about $29.52 as of inputting this here. And so again, we've eclipsed these projections already in silver that Gregory Shearer made, but what are the updated projections stating right now? When we look at it, we have both TD Bank, but we also have Bank of America forecasting for large gains in silver. Daniel Gawley of TD Securities, it stated last time that silver held $30 support, it went to $50 within 10 weeks. And he believes that the renewed investor demand that we're seeing, along with the growing deficit, and when I say deficit, silver is in a major supply and demand crunch at the moment. He believes that this will provide long-term support. Now, the primary reason for his forecasts are the same. It's falling yields and US dollar due to interest rate cuts. Now, the thing I want to cite that's different, some of you may know, silver hit $49.82 an ounce in 2011, okay? It went up and it came right back down. The major difference that we're seeing in the rally now than what we saw 13 years ago rather, is that we are seeing sustained support at the 50-day moving average. Sustained support at the 50-day moving average. And additionally, what we're seeing is silver is not moving straight up in a line. We're seeing it take 2 steps forward, 1 step back, meaning in a healthy market, you do not want to see things move straight up in a line. If they move straight up in a line, they tend to come back down in a line. We're seeing silver move up, come back half a step, move up again. Higher highs, higher lows. Now, more conservatively, we see Michael Widmer, who we were just talking about when we were talking about the gold projections. He's seeing silver's next move at $35 an ounce, with more upside depending on the potential, more potential upside rather, depending on the gold market. And I will cite what this potential upside is when we get to the gold to silver ratio. I want to explain it clearly with that slide. But moving forward here, this is a recent chart for silver that I want to highlight. There's a few key tools that we're seeing here. Number one, we've got a head and shoulders pattern on the chart with silver. Head and shoulders can be bullish or bearish. It's a change in trend within the market. What you'll see, and I mention this because you'll see the shoulders where the S are and the head where the H is. What we know is this is a change to a bullish trend in the market, because of the fact that we've seen the market respond from a trend at $24 up to 32 and change. Now, additionally, you'll see we're starting to form the same thing that's happening in gold, a pennant pattern here as well. 32.75, we've consolidated down into the mid $29 range. And as we're seeing those highs and lows get tighter and tighter, it's the same thing as gold. It's like compressing that spring in the pennant pattern. We're going to see it explode up again. So you'll see we move up. Remember, I said higher highs, higher lows. We move up 2 steps, we come back half a step. The market breathes, it gains momentum. We're going to see the same thing happen again. Now, in terms of price point, I just want to show people this tool as well. This chart also forms what could look like to some as a cup and handle. A cup and handle on the chart, if we look at it, the depth of the cup will predict the future price. And so if we look, the depth of this cup, the lowest point we can readily see is $11.64 on the cup. The highest point on the exit of this cup is $30.35. So that's a $20 move. So if we follow along the handle here, a $20 move with this cup and handle from where we are at today could potentially take us to $50, which is right in line with what TD Securities and their analysts have been saying. Now, just to move forward, and I see on the PowerPoint, it may be a bit blurry to some. This is the best image I could get of the chart. I wanted to show what happens to silver during an interest rate cutting cycle, okay? The average gain in silver in interest rate cutting cycles over the last 20 years, the last 3 of them rather, has been 413%. When rates were cut during COVID, we saw it move 250%. When rates were cut previously, after the Great Recession, we saw it surge 502%, right? That's the last time we saw it near 50. So another just fantastic tool for looking at how rates and the dollar could affect silver here. Now, this is where I wanted to touch on the gold to silver ratio for everyone here. Number one tool when determining what we should buy, gold or silver, right? Because they trade in tandem. On average, in the 20th century, you could buy 40 ounces of silver for every ounce of gold, okay? During the 21st century, we've been probably in the 55 to 60 range in the gold to silver ratio. And the ratios moved as tight as 14 to 1. In 2011, it went to 14 to 1, and some experts believe it could do that again. The ratio, as we're talking, is 80.29 to 1. And if anyone's wondering, the way you get that is you take the price of gold and you divide it by the price of silver. And that gives us 80.29 to 1 this second. The significance of this is anytime that ratio has been wider than 80 to 1, silver has typically made 4.5% for every 1% that we've seen in gold. So when we say additional upside potential, Widmer from Bank of America was saying that, Shearer from Chase was saying that. What are we talking about? Well, simply put, if we see gold move to $3,000 like has been forecast, if anyone has an iPhone or a calculator on them, it's real easy to do. If you put $3,000 in your calculator, and let's just say we divide it by 60. I know I said it's been 55, it's been as tight as 14. Let's say we divide it by 60 to 1. What you're going to get is $50 silver. So Widmer projects 35 over the next short term. TD Security is saying $50 by next year. And you say, well, where are they getting $50 from? It's from the $3,000 projection in gold. So they believe with gold moving to $3,000, we'll see $50 silver, and that is supported by the gold to silver ratio, as you'll see. So just before we wrap up, because I know I've given everyone a lot of data here, I just wanted to show this for everyone. This is the market cap of various stocks, but also the gold and silver markets. And I mention this because, sometimes I don't think people realize how big those markets actually are. when we look at things, and this is increased, this is not to this second, but when we look at things on this chart, the combined market cap of gold and silver is $15 trillion, which it has now eclipsed that. It is a huge market. Now, what I want to show everyone here is this is a study. It was a 50-year study. It was done by CPM Group, and this is on allocation strategy. Okay, what they were trying to discover with this study is from 1968 to 2018, what would be the ultimate portfolio for good times in economies and bad times in economies? How could you allocate yourself so no matter what the market was doing, no matter what the economy was doing, you could receive an optimal return? Okay, they believed that what was called almost a permanent portfolio, the rebalance of 25% in metals, 75% mixed between stocks, other physical assets like real estate, and cash or T-bills was optimal. What you'll notice, and I have this on the next slide, you're going to see with that type of allocation, they had over 50 years investors averaging over 7.5% returns. Now, they cite an aggressive investor, and just to inform everyone here, an aggressive investor is someone with multiple streams of income. We're talking over 5 streams of income. They state this as someone who should have 10% in precious metals. And finally, here on the far right, we have billionaire Ray Dalio. Ray Dalio is the founder of Bridgewater and Associates, the largest hedge fund in the world. He currently has 7.5% of his portfolio in metals, a mixture of both gold and silver. And this chart here is exactly why CPM made that allocation strategy. What it shows between the X and the Y axis is showing us the return. The X axis is showing us the risk. And when we say risk, we're not talking about risk that you face in holding a certain investment. Their evaluation was risk that you could lose out on higher returns with other prospective investments, speculative investments. So you'll see in the 25 to 30% range, people over 50 years were averaging almost 8% returns per year for 50 years. Now, you'll see actually as the allocation gets higher for having gold and precious metals in your portfolio, the return's better. 70% of the portfolio, people are getting over 9% a year. The downside is your risk of missing out on a more speculative investment that could yield you a higher return goes up. And so ultimately, like I was saying, there's no one-size-fits-all approach here. But at the end of the day, you want to make sure that you can tailor fit your portfolio to meet your needs and be able to accommodate yourself in all situations, not just when the economy is good, but also when we're in a downswing and we face turbulence. So, moving forward here, just before we wrap, I think one thing, if I could get it across to everyone here that I want to say, is when it comes to the actual products, I know we didn't really touch on products. My biggest piece of advice to everyone is do not get sucked in to graded coins, collector coins. I know they're not IRA eligible, but companies will find ways to sell them in an IRA. I'm trying to help a client out right now, for instance, who was talked into purchasing proof gold eagles at a massive premium. If I have any advice to you, don't do it. We specialize in what are called investor bars. These are kilo and 100-ounce bars of silver and 10-ounce and kilo bars of gold and platinum. These bars all have serial numbers on them. Most of them have a hologram with a QR code on the back. They hold their value because of the fact they're able to be identified. And additionally, you're not paying the crazy premium of these coins. A lot of dealers will try and pass off these coins at premiums above 50% without telling you anything from it. Don't do it. If you ever have questions with it, don't hesitate to contact us. I'm happy to talk to anyone about products or pricing at any time of day. Just don't make a whipsaw decision to buy coins. If I could tell you anything, I know I'm really rapping on it here, but that's the most important thing I would say. Bars over coins. If you want smaller denominations, you can buy smaller bars, or you can buy rounds. They're not as intricate as coins. They don't have the same premium. So I just want to throw this up on the screen for everyone here. The phone number on here is my desk phone, which unfortunately it rang a couple times as we've been on the webinar. I'm sure everyone heard. That's my direct line. If you don't catch me, leave a message. Whether you want to review things, whether you want to look at putting a part of your portfolio in, or whether you have metal you want to sell, let me know. I'm happy to help anyone out. My email is there as well. Don't hesitate to contact us. And if you have any questions, if you don't want to ask them in the chat, feel free to reach out to me personally. I'm happy to answer any questions and, you know, educate you on whatever it is in the metals market that you want to learn more about. But that would do it for me. And I would just want to thank Scott for having us on here. And if anyone has any questions, please don't hesitate to ask now.
Yeah, thanks, Greg. Great information. Yeah, again, we have a question pop up. I'll get to it in a second. But I wanted also, yeah, anyone who's listening now, get your questions in now. We'll be ending it here shortly. Again, my information is here on this slide. If you have questions about self-directed IRAs, happy to get those to you. But yeah, Greg, I guess when in going over a lot of the data, just to I mean, obviously it seems like there's a lot of support for prices and gold value going higher with the market. What are what is the downside? What's the potential risks of the markets? I know everybody's predicting they'll go higher, but what's the risk of them all going, actually going down? What are some geopolitical factors or some economic factors that would cause these values to actually come back down a little bit? So if you're looking to make, who's looking to try to get into the market at the right time.
100%. And Scott, I think that's a great question. When we look at the risk factors where we're at right now, we have geopolitical tensions, right? There's multiple wars going on. We have Putin that's just signed an agreement with North Korea very recently. We have BRICS in terms of we have nations that are no longer taking US dollars for oil. These are all things that add to the price of gold and silver. If you want to look at risk for what could in the short term send prices down, it would have to be something like we would have to see ceasefires in the wars going on right now, peace resolutions. Additionally, on top of that, we would have to see a curb in central bank buying of gold, right? Like we would have to see an announcement from China, like we're not buying any more gold right now. It's certainly possible, looks unlikely though. If we did see something like that, right now, the 50-day moving average and strong support for gold is at $23. We have strong support for silver just above $29. Meaning we're right on these moving averages on the lows right now in the ranges that we're at. Could it take us below that? Potentially. But the thing is over the long term, and when I say long term, I mean 6 months. We know for a fact the Fed cannot hold rates where they are much longer, right? We've seen more business bankruptcies in Q1 this year than we saw all of last year. Additionally, commercial loans, when we're talking about office space and we're talking about multi-residential loans, these are at the highest risk they've been in years. We're seeing a ton of foreclosures start to come forward. And so regardless, if these factors were to subside and we'd see it come down short term, we know long term interest rates coming down, the price will move up. But it would take a massive change. To answer your question, Scott, it would take a massive change in either geopolitical tensions, demand with central banks to actually change the price negatively in the short term.
Gotcha. Okay, great. And kind of just maybe a general question on advice for holding metals. Do you have a general, someone who's looking to get into gold or silver, a time frame of how long, if someone who's going to buy them, how long they should expect to hold them, or is it is each circumstance a little bit different for a client? Obviously, Yeah, I know you don't believe in day trading gold and silver,
Yeah.
obviously, like trying to get out really quick. But kind of what is a guideline for someone? Is it you should expect to hold the metals at least 6 months, a year, 5 years? Kind of what is your general guideline when talking to people about buying metals?
So again, the thing is with a general guideline and time to hold, it's going to be personal, a very personal decision, right? It depends also on what your goals are. What we're seeing right now in the upward movement in precious metals is somewhat unprecedented, right? We saw it in 1980 and we saw it in 2011. Those are the only two other times we saw price swings as quickly as we have now. The reason I mention that is quite feasibly, like if you had bought March 20th when we last met, you could sell today at a profit, right? And that's not something that happens all the time in precious metals. Typically, what people like to look at is it's a value store. So the mindset of people who invest frequently in precious metals is you put a percentage of your portfolio away. It's something that you hold. And when you need the funds, you can liquidate, right? Think of it like a savings account. It's still liquid, but that's going to match inflation over time. And with what's going on right now, most likely you're going to beat inflation significantly. I would say the average the average holding time, I would say, would be 2 to 5 years, really. You could do it for 6 months, like we've seen. If you did it over the last 6 months, you still would have made money. But if you really want to maximize the benefits, it's a longer term hold, right? It's something that you always want as a piece of your portfolio. Not that we're saying it needs to be all of your portfolio or half of it or even close to that, but it's always good to have a small percentage to ride over time, just as an insurance policy, so to speak.
All right, thanks, Greg. And one final question. I know we're here at the top of the hour, so we'll end it after this question. Someone asked, when the investment is liquid, you say the investment, we're buying through Allenhouse's investment is liquid. How long does it
Yeah.
typically take to get your funds? If someone's looking to sell their metal, how long does that process take typically? Are there different factors that go into, how long it may take?
Yeah, that's a really good question. The thing is, for us, when it comes to the sale of the metal, it is dependent on the depository themselves, right? The depository has to physically move the metal out of your account, either into our account that we have at the depository or into the warehouse, like in the case of IDS Texas, right? So these processes have varied over not just the last few years, but they varied this year quite frequently. In the sense, we had a client in March who liquidated. She was liquid same day. The depository was, they were low on work. They were able to move the metal same day. In other cases, we can see it taking 10 business days sometimes. We always do our best though to liquidate as quickly as possible. I know I just had a client submit a liquidation. The depository rather was taking longer than desired. And we actually funded the liquidation and sent the money to the client before the metal had moved out of the account, just because it had been 10 business days. So it's dependent on the depository. They would like to keep it within 2 to 3 business days. Typically, it's within that range. It can go up to 10 business days, though, as well.
Okay. All right. Well, again, Greg, thanks for the great information today. Thanks everybody for attending live. If you listen to the live version, you'll get a copy of the recording in your email. You can reach out to us. And certainly, if you're listening to the recorded version, you can reach out to Greg. He had his information up earlier. Certainly, my information here if you have any questions about self-directed IRAs or what the process looks like. So, again, thank you everybody for attending. Greg, thank you again very much for your time.
Awesome. Thanks for having us on, Scott. Really appreciate it and hope everyone learned something from today.